Hey, Todd Sachs of Sachs Realty, and I'm really excited to bring you this podcast, the episode of Things You Should Know. And I am honored to be here with Ken Solow with Pinnacle Advisory Group. And Ken is he's a financial planner. They operate in two states, Maryland and Florida, with Maryland being their headquarters. Ken's an expert in what's going on right now. And I'm really excited with COVID-19, with this pandemic going on, and so many people just kind of freaking out, wondering what's going on in the financial market. I'm also joined today with Ruth Lyons. She is a real estate agent with Sachs Realty, but she's also an author. She writes for Investor Junkie as well as Bigger Pockets. She writes on more of the real estate side of things with financial investing. And actually in corporate America, Ruth actually worked in the financial market industry. I'm also joined with Melissa LeVie, who is my personal assistant. She's got some great questions too. And let's just jump right in. So Ken, welcome. And, kind of tell us a little bit about you, your company, and we're happy to have you.
Well, I'm really happy to be here. Interesting times, I guess. We live in interesting times. I've been in the financial planning business since 1984. Started with a very big company on the insurance side of things. Learned the investment business through that lens. 1991 left to start my own firm with who are now three of the founding partners at Pinnacle Advisory Group. We established the firm in 93. Basically, I always gravitated towards the investment side of our business. By the late 90s, I had kind of the unofficial title of Chief Investment Officer at Pinnacle. When we got to, and I don't know if people remember, but I like to remind them, in the year 2000, 2001, we had a gigantic crash in the markets, mostly in the NASDAQ stocks. And after that, at Pinnacle, we kind of circled the wagons and said, look, we really need to do something different if our business model is going to be an asset under management model, which we can talk about today if you'd like. And so we did change, and I took the official role back then. That was in 2002 of Chief Investment Officer. Today, Pinnacle Advisory Group has about, I lose track of this, maybe 1,300 families that we do their financial advising for. That's financial planning. And we manage their assets. Me and my team manage $2 billion plus in assets for those clients. We also have an institutional business. We manage over $400 million for institutional registered investment advisors who basically look to outsource their investing through us. And that's because we have a large investment in this business. I work with 3 chartered financial analysts and 1 chartered market technician. So it's a very in-depth and sophisticated money management department that I get to oversee.
Yeah, and I know you guys are very well respected. In fact, we were introduced by a very close friend and mutual friend. And I'm kind of curious though, Ken. I mean, kind of wondering what a young Ken Solow was like, and how you ended up picking this market. I mean, were you a numbers guy when you were young? I mean, when you were a kid, were you the one that was figuring it all out? Were you great in math? I mean, tell us a little bit about young Ken Solow.
I think I was a sales guy. I don't think I knew it at the time. I grew up in South Jersey, went to school at Towson University, not called that back then. It was
Towson State, right?
Towson State. But I was there to play in the jazz ensemble. There was a director there named Hank LeVie, who was nationally known, and I played drums in that band. But somewhere along the way, I got a sense that maybe I'd be good at sales. I went to work for Burroughs Corporation, I was in their office products division and basically just learned the nuts and bolts of sales and selling, and ultimately answered an ad in the paper for Cigna Financial Services Company. I had absolutely no idea what any of this was about. I just knew I wanted to make a bunch of money back then. And as it turns out, the financial services business is a business where you develop intimate and long-term relationships with people. And if you can obsess about financial issues and at the same time do good with hanging out with people, just by total accident, I think I ended up in exactly the right business for me anyway.
Ken, when was the moment, when did you decide that you wanted to start your own business?
Actually, my current partner, John Hill, one of the three amigos who started Pinnacle, we used to spend a good bit of time, as most, you'd probably relate to this, but young professionals having a beer after work. And when you are in a commission-oriented business, which you guys are, but especially in our business, where the gray areas about how to manage to commissions and trying to figure out how to keep your client's best interests first, it got to be an overwhelming issue. And we changed from a commission model to a model where we charge fees for assets under management. And without getting into the details of that, it basically switched our success model to, we were either going to provide incredible service and retain clients over time, or we would have cost ourselves a lot of money and we should have just stayed put. And making that change, as it turns out, doing that in the early 1990s just put us at the leading edge of what became a tidal wave of this model of AUM and money management. Nowadays, it's very unusual to find even stockbrokers, anyone who's in the business, insurance folks, to be compensated by assets under management is pretty typical nowadays. Back then, though, we were on kind of the leading edge of something.
Wow.
So you kind of covered this, Ken, but what made you choose your career?
Once I got into it, and I think it was a total accident how I chose this career. I mean, I'd like to say that it was me trying to figure out my personal characteristics and what industry I should do and how. But I remember it very well, laying on the sofa reading the sports section, and on the back was an ad for Cigna Financial Services Company. And back in the day, they said you could make the average agent made $50,000 after 3 years. And I thought that was an obscene amount of money. And I called the number and I went down and interviewed. It turned out one of the guys I interviewed with was Dwight Michaelis, who's one of the current founding partners of Pinnacle Advisory Group. The three guys who are the founding partners and majority owners of Pinnacle, we met each other within 2 years, all there at Cigna, and we all were there when we started Pinnacle. But as I said, all three of us as it turns out, incredibly client service oriented. And to be honest with you, it's an extraordinarily challenging field. For me, the longer I stayed in it, the more fascinated I was with it. If you're engaged with money management, we'll be talking about those issues. But even on the financial planning side of it, working with people, helping them meet the financial planning challenges, both as they go through their cycle of life, whether it's estate planning, which is how I started in the business, or nowadays more accumulation planning, which is on the investment side of the business. It's an overwhelming challenge. Of course, now Pinnacle has 50 plus employees. We're a bigger business. And, as Todd knows, as you all know, then you kind of switch gears as you go through your career. And then growing a business becomes its own challenge. And I'd probably say that's as much where I am nowadays as when I started.
So we're going to dive right in to discuss the topics on what's on everyone's mind. What is happening right now in the markets?
Well, right now, what's happening in the markets is investors are trying to figure out if the worst is behind us. And so, we live, as I said earlier, in interesting times. We've never had in history what I call recession by proclamation. Okay, usually it takes the markets a while to go through a whole lot of data to figure out whether or not we're in a recession. In this case, it took about a week. And once the markets figured out that COVID-19 was going to be a global pandemic, the speed of the market decline exceeded the 2019, but the market crash in the Great Depression. Okay, an extraordinary decline in prices. But what was interesting, the point total, the percentage decline of 34% made it just an average bear market and less than an average bear market from a place where the S&P 500 had just knocked out new highs on the index. So for the market to decline 34% and then turn right back around and rally 25%, the market in record time fell from peak to trough, and then in record time rallied from the trough back and regained 50% of the value that was lost. And so today, the market, I was just looking this morning, since April 9th, the market has been trading in a very, very tight trading range around 2,800. The market had bottomed. When I say the market, we mean the S&P 500 stocks. But it had bottomed around 2,200. And investors everywhere are trying to figure out, we have in front of us, and we're in the front edge of this, the most extraordinary, devastating set of economic data that we're likely to see in our lifetimes. I mean, these are Great Depression level data series. We got unemployment claims today for, I think it was 4.5 million claims. We're on our way to probably 20% unemployment, which, depending on the economist, 15 to 20%. That is a Great Depression print. The range for GDP estimates for the second quarter of this year, we're seeing the very lowest end of the range at -10. We're seeing the bottom end of that range at -50. with the median, I know at Pinnacle, we're looking at probably minus 25 for the second quarter. These are unbelievable numbers. But offsetting that has been an unbelievable, incredible policy response by the Federal Reserve and Congress. And so when you add up fiscal and monetary stimulus, it adds up to about 35% of GDP. It's an enormous, unprecedented, extraordinary number. And so investors are trying to figure out, it's so bullish, should we be looking through this economic calamity we're in now? You buy stocks when there's blood in the streets. They're looking through what everyone sees as a devastating earnings decline and saying, well, let's buy that earnings stream on the other side of this. If you're bearish, and Pinnacle is still built, we're tilted slightly bearish. In our view, the market probably, we would like to see it go back down and retest the lows. We think that we really haven't seen, for me personally, it makes very little sense in light of the world turning off the global economy that we would get a 30-some% decline and retrace 50% of it, and we're finished. We're just done. So, but that's what investors are trying to piece together. And the only thing I would say is we're not getting much help from corporate America. So we're in the middle of earnings season. And, as you know, stocks in theory are somehow based on cash flows and earnings from companies. But through this part of earnings season, corporations are pretty much throwing up their hands. They're not giving any guidance for the rest of the year in record numbers. So if you're on an earnings call, these companies have nothing to say going forward. Okay, so everybody's talking about first quarter, which includes a few weeks of COVID-19. But it's not what we need to know, right? So everybody's throwing darts at this point. And lastly, we can talk about this, so much of it has to do with the virus and your view of how we get back to work. How do we reopen the economy? Everybody has an opinion. I'm happy to share mine. It's probably as good, but no better than yours. But, you tell me if you watch Fox News or CNN, and I can probably tell you how you feel about this. So, but that's a big part of the investment view. If, for example, in the fall, you get a rebound in virus cases, if you believe that opening too early will elongate the slowdown ultimately, okay, that's going to have an impact on how bearish you are. If, on the other hand, you take the stance that this is a positive situation, we are going to be opening the economy, the quarter-over-quarter numbers can do nothing but get better, well, then you're going to be a little more bullish. So investors everywhere have turned into virus experts. And that's, in your business as well as mine. That's what we're doing.
That does seem to be true. Everybody's a virus expert, but nobody really knows. One anomaly we seem to be seeing in market correction, or however you want to call it, is that stocks and bonds are declining at the same time. Is this the first time to happen? And what do you think is the underlying cause of this?
I think we need to be a little clear about this. Stocks and bonds have diverged dramatically. Bond prices have rallied. They've gone up. Treasury prices have gone up significantly. We're looking at, if you want to lend money to the U.S. government for 10 years, you're going to get paid less than 1%. So when yields drop like that, prices of bonds have gone up. Prices of bonds across the board have gone up. But what I think you may be referring to is there was a period there for a week, I don't know, less than 2 weeks, where the market literally stopped functioning. Their liquidity dried up. It was very reminiscent for those of us who were around in the great financial crisis. The same type of thing happened. And we did see for a short period of time prices of stocks and bonds falling at the same time. The Federal Reserve rushed to provide that liquidity. And once they did, all the bond spreads, they're called the spread between the yields on, let's say, corporate bonds and safe treasury bonds, those spreads snapped back to where they were. And ever since, the bond market has been trading much more reasonably, much more rationally. So, yeah, there was a period there where it was pretty scary. I know we tend to use exchange-traded funds for much of the work that we do. And there was a couple days where our traders could not sell those securities because the spreads had just blown out. And so the prices were not rational. But like I said, that was a period of days. Those investors who have had balanced portfolios here have been richly rewarded for having a balanced portfolio. So, and just to give you some ranges, and if my compliance officer was listening right now, she'd be having a heart attack. But, a balanced portfolio is probably down right now, year to date, somewhere between 7, 8, 9, 10% in that range. With the headlines, and people get confused. You turn on TV and you see that oil prices put in a negative print and they're down 50%, and the stock market's falling to pieces. And, we're having this discussion today. But in the fourth quarter of 2018, the stock market declined by close to 20%. In this case, the stock market declined by 34% intraday and rallied back instantly rallied back. So the portfolio damage for the 3-month period ending 2018, which happened because the Federal Reserve was talking about raising interest rates, and investors were going crazy. And so they were bidding down stock prices. The damage that balanced portfolio investors are experiencing is no worse than that, as hard as that is to believe. And so, yes, bonds and stocks have both served bonds have done well. They have rallied. So,
Ken, let me ask you. So, obviously, we all know. 3 weeks, 3 short weeks. We saw, complete market devastation,
yes.
and then we did see a rally. Can you just kind of explain? Some people talk about that V recovery. Some people say, depending upon, and you kind of touched on this, depending upon, any kind of resurgence of COVID-19, as to, what your beliefs are. I hear you, and whether you're, bullish or bearish. And sure, that a lot of that is speculation, and because we don't know. But can you kind of talk about, historically a V recovery, and then when that happens historically, do we see a major sell-off? So when you're saying these investors, that are well diversified and maybe they're experiencing, 7, 8, 10%, whatever, that they're off and where they were or whatever in their portfolios. What happens in that V recovery typically when it hits that new high or back to where it was? Do we see a sell-off?
Yeah, well, there's a lot of stuff there, and most of it deserves, I think, to be addressed. So first, let's talk about V bottoms. And let's not get confused. We can talk about V bottoms in the stock market, or we can talk about V bottoms in the economy. And today, the alphabet soup here is getting a little confusing, whether it's a V bottom, a U bottom, an L bottom, different economists have a view. Almost all of it, by the way, again, has to do with how soon we can open up the economy. And it also has to do with growth rates. So if you're looking at quarter over quarter numbers and you start with a minus 30% in GDP, okay, things get a little bit better. The quarter over quarter numbers begin to jump to a +5, let's say. But that doesn't mean GDP had made a new high. It's just off of a low base. Any kind of recovery gets you to plus numbers, plus numbers, plus numbers. So as far as the stock market is concerned, our work would say that V bottoms are pretty rare. All right, typically the stock market does not make a V bottom, but interestingly enough, it just did. Not this bottom, but the 2018 bottom. Okay, beginning in January of 2019, or actually after Christmas, the Fed chairman gave the right words that, no, we're not raising rates. We're going to be much more moderate. The market took off and never did retest. So for those investors who are like, well, these V bottoms are really rare. Typically, markets bounce around and actually make new lows in a bear market. While that may be historically true, you don't know. The other thing is when you look at these V bottoms or W bottoms or whatever they are historically, they did not have 35% of GDP of stimulus that came in perfectly timed right at the bottom. So you really have to kind of wonder whether you need to just throw all of that history away because you're in this unprecedented situation with stimulus that we just didn't have before. The last thing you mentioned that's kind of interesting is just the narrow breadth of this market and what typically happens. So historically, after a recession, value stocks, small cap stocks, mid cap stocks would typically lead coming off the bottom. As a matter of fact, I was listening to Bloomberg this morning. Sure enough, there was an analyst for a large insurance company talking about, yeah, you got to rotate to smalls, mids, whatever, value. Traditionally, that's what would lead. But in this market, both before the sell-off, during the sell-off, and now in recovery, the same 10 to 15 stocks that everybody knows which ones they are, the FANG stocks, Facebook, Amazon, Netflix, and so forth, Microsoft. That same group of mega technology, communications, community discretionary stocks are leading the market to a huge extent. The gap in performance between the top 10, 20 stocks and the rest of the market is historically large. And so investors also are trying to figure out how do you ride the winners from here going up, or do you rotate out of the winners and move to more small caps, value stocks, and those stocks that have been the clear losers? And I don't mean losers just for this cycle. They've been losers for a decade now. So it's kind of an interesting time. I can tell you we're overweight technology. We are dramatically underweight financials. So we're still kind of riding that growth, large cap growth idea. But that's something else that investors are obsessing over. If they are, by the way, that all assumes they're actively managing money. And most retail investors are not doing anything of the sort.
Ken, how does unemployment, so you talk about the unemployment rate, I mean, we see it in the headline news. How does the unemployment rate affect the market?
Well, start with the obvious. Folks who are unemployed can't be consumers. The United States, our economy is a 70+% consumer-driven economy. So the dominoes begin to fall. Start picking any of the either consumer staples, consumer discretionary, and you begin to see, even in the staples, when people are unemployed, now you're starting to look at, well, how long will it take for safety net payments to make their way out to these folks? So you can buy staples. But on the more obvious side, and just to give you some insight, we were looking, my team, just this morning, talking about retail. Is it time to buy retail? There are exchange-traded funds that just focus on retailers. There's some that are cap-weighted, meaning Amazon is 20-some% of that exchange-traded fund. But all the winners, the retailing winners are in there. Okay, there are other exchange-traded funds that are equal-weighted. So you have a lot more smaller companies. And the team is debating, are you going to get a rip higher with those smaller retailers? Or are they just going out of business? I mean, are they just going and, we may be professional investors, but I don't think I have the courage to get there.
But I guess, and just out of ignorance, I mean, as someone that does invest in the markets, but are we just in denial? So when we're looking at the recovery that's happening right now, and we're talking about somebody that's well diversified, not being down an extreme amount compared to some of the other crises that we've had. At what point does the unemployment affect? When we know, I mean, in our business, we know, people are buying houses with very little cash. We see that their financial situation, they have very little savings. And then we're looking at, depression, the Great Depression type of, unemployment rates. At what point does that really start to hit that market to where maybe people are in denial and we start to see those more tumbling numbers in the market?
Yeah, how that corrects, how quickly that corrects, nobody knows. I mean, so now you kind of draw your lines. If I'm bullish, I'm saying that it can't be worse. We're at 15 to 20% unemployment. That's where we're going. The market's already priced that in. The only thing that's going to happen from here is it's going to get better. Now, it might not get better quickly, but it's going to get better. Yeah, unemployment claims are going to go from 5 million to 4 million to 3 million to 2 million. And as it does that, you want to be on the right side of that. I was just looking the data this morning. It looks like the data for refinancing looks pretty strong, as you'd expect, with interest rates down. There are mortgage applications look pretty decent nationally. The Fed is backstopping that part of the economy, which is one of the real themes for investors. If you're going to invest, why not invest where the Fed has a few $1 trillion backstopping you? And we're seeing that So what did I write down? I wrote down something this morning. So not to get into the details, but there's this alphabet soup of derivative securities that make up parts of our business. One part is called CMBS, collateralized mortgage-backed securities. These are these derivatives that are put together by Fannie and Freddie. They have the different tranches that are rated and they get sold out to the planet. And the Fed, some of them are agency-backed with Fannie and Freddie. Some of them are non-agency-backed. But the Fed has already said we're buying the agency-backed. Okay, so
sounds like 2008.
Yeah, well, no, it's not like it. It is exactly 2008.
Right.
It is the same names for these programs. That's one of the reasons they were able to come in at lightning speed here, because they're just dusting off programs they used in 2008 and putting them out in the marketplace. But back to your point, does this mean we're going to have a whole bunch of what are called zombie corporations out there? These are businesses that probably should be let go bankrupt. Just let them go bankrupt. Okay, we're a capitalist country. Okay, does it help anyone to have a bunch of businesses that will never crawl out from underneath their debt to just support them on the public's, money? I don't know. So if you're bearish, like I said, I tend to be tilted that way. Then you're saying, getting 20% of the population who's unemployed back to work is going to be a long process. And the knock-on impact of that in terms of all the industries we're all talking about, whether it's restaurants, whether it's cruise ships, travel, airlines, so on and on and on. Maybe that takes a lot longer than what the market is currently giving it credit for. If that's the case, then the market is clearly overvalued.
So what industries do you see bouncing back, and what industries may never bounce back at all?
There are some industries that are thriving in this environment in the first place. So and as I'd already said, what are called the early cyclicals, I think, are doing well. Those are technology, all the technology companies. These are, creating software, these productivity profit creators. They're going to do well. The content creators are going to do well, as we know. The consumer staples companies never had a real problem. They're not going to have a problem going forward. The companies that are at most in danger by far are in the oil patch. Okay, so and it's kind of interesting. Over the last 4 or 5 years or more, we've developed in the United States a degree of oil independence here, energy independence we all grew up in an environment where what OPEC said is what we did. And now we live in a different world, or we did. But if the price of oil is going to remain below the break-even cost of U.S. companies who are fracking and drilling and doing all that stuff, that whole industry could collapse. Where you would see that is, and I can tell you where investors are spending a good bit of time is, first let's talk about the bonds. So you may have heard the term junk bonds or high yield bonds. A lot of folks have a mutual fund or an index in their portfolio for junk bonds or high yield bonds. They're bonds and they yield more than the other bonds, so why not own some? But if you dig into those portfolios, you're going to find a good chunk of those junk bonds are from companies that are energy companies. So there's a lot of concern about what kind of bankruptcies you might get and what kind of return you're going to get in those bond portfolios, and consequently, what kind of returns you would get in a junk bond fund. As an example, on the equity side of that, let me give you the good news. The bad news is that we're all following with some horror and a secret amount of glee. We're trying to figure out, wait a minute, if they're literally paying people to take their oil, how low could gas prices go at the pump? But we don't like to say that out loud because we're patriotic Americans. So I guess we're rooting for our frackers. They're better than the Saudis and the Russians. These are our guys. And so that's great. I'll pay higher prices. But as a percent of the economy, if you went back 20 years ago, that was about 20% of the S&P 500 index. Right now, it's about 3 to 4% of the S&P 500. So closer to 3. So we are underweight energy stocks in our portfolio. But I think that we're looking opportunistically. The valuations of those companies have really been beat up. So if you're a long-term investor, maybe that's an idea. So in terms of what's going to disappear, go away, I know on the real estate side, and you guys must be seeing this all the time, especially on the commercial side, you get what's going to be doing great is commercial and the warehousing side, right? We're all getting stuff delivered at home. Warehousing, I would think, would be an area. If you look within the REIT part of the market, REITs are another small percentage of the total stock market, maybe 3% of the stock market. But so you get that. And then what's on the other side of that? The other side of commercial would be retail. And again, I'm sure you all are having these conversations about.
Oh, yes, we are.
Of course, if everybody's used to working from home, what will it take for business owners to decide they don't need to lease space? We'll just keep people working from home. So who's the winner? The winner is Zoom and all the technology cloud companies that support what's going on right now. The whole country is forced to do this. Who would have thought it? And the potential loser is, those folks who own the real estate that all of a sudden trying to get to the same occupancy levels on the commercial side. I don't know, maybe a little.
And it already very historically low cap rates. So, I mean, we're seeing some of the lowest cap rates we've ever seen. And so especially in certain sectors, I mean, it's just so competitive. And I mean, you're exactly right.
And I think you and I may have been talking about this before. There's a flip side of that, which is while business owners may have had this kind of esoteric hypothetical conversation about, can we just send everybody home and work this way? It's kind of interesting. I know at Pinnacle, the vibe is already around. People miss each other. Mm-hmm. It's not the same. It's just not. And as a business owner, whatever that electric vibe is in the air that your team gets from being together, going out to happy hour together, or doing the things that they do, I think maybe it goes the other way. And business owners just reconfirm that there's real value. Maybe it's an intangible value, but there's real value to being together as a team. So, that's what makes a market, right?
Yeah, a lot of what I'm seeing, and I have, I've certainly been having a lot of conversations with, business owners and I think a lot of what we're seeing, at least in a lot of the data that is coming forth, is that there will be a mix. So I think there is a certain amount that will stay home. I think a lot of companies are planning on a certain percentage of that work week working from home, not necessarily the whole week. So, and let's think, I mean, hundreds of millions of dollars have been spent on, purchasing extra computers for people to be at home, or laptops, and, having those types of network connections, programs that they were never, was never on their, financial sheet. And so a lot of that, out of pure necessity, they want to keep some of that in place because they've spent money. They want to recapture that. But I think people have also realized that, yes, though the camaraderie is important, and it is that high five in the office that keeps things really exciting. But they also know that, if their employee worked at home 2 days a week, they could, potentially have even more production because people are more focused. The meetings are more focused. You're not, shooting the breeze for 20 minutes in the conference room. You're actually getting down to business on a Zoom call or something like that.
I know for us, we tend to view real estate as a portfolio asset class. I already told you in terms of the stock market in general, REITs are a very tiny portion of the stock market. They had recently been spun out by the S&P into their own sector. As a portfolio asset, as a financial planner, there's always some degree of debate about how to treat people's home equity, whether it should be treated as a portfolio asset or whether it's not. It's just a home equity that really is never going to get spent. It's not productive in that way. It's certainly productive in terms of people's quality of life, but it's not the same as a liquid asset. So here we are, and that's the other thing about the virus, that while we could have a good, vigorous debate about how long it's going to take us to get to the peak and whether or not they're rushing test kits and doing contact tracing in a way that'll prevent a resurgence, and how people, especially consumers, are going to behave prior to having an actual vaccine, so that we're all going to adjust to this new risk level. Okay, and while we can, debate all that, what we're not debating is that 2 years from now, there's a high probability we're going to be on the other side of this. There would be a vaccine. I mean, at least that seems to be the accepted wisdom. And if there isn't a vaccine, there would at least be an effective treatment. So that being the case, especially when we're talking about real estate, which is not easily priced unless you own REITs in your portfolio, like an ETF, an exchange traded fund, what I would expect is we have a huge deflationary force here, and we're going to see real estate prices fall. Okay, but since this is a short-term issue, call it a year or 2 year issue, then how do real estate investors look through that the same as equity investors? Do prices just pop right back out? Would you expect that if you did see prices fall due to this deflationary impulse that we all think is short-term, and knowing the Fed is backstopping all of this to the tune of 35% of GDP, do you just look at this as the biggest buying opportunity on the planet? And I'm not in the real estate business, but certainly from a portfolio perspective, that is on our minds. The other thing, by the way, is that REITs fall into that category of investments that trade. They tend to trade based on the income they produce. As they trade like a bond or a bond alternative. When interest rates are falling, REIT prices are going up. When interest rates are rising, REIT prices are going down. We seem to be in an environment here where investors are trying to figure out, well, okay, why are interest rates falling? In this case, they're falling due to this, like I said, incredible deflationary surge out there. So is that positive or negative? I don't know. For us, we are neutral on REITs in our portfolio, so, for what it's worth.
So what would be considered the new norm for the market in your view?
Well, I guess we'd have to figure out what that means, normal, before we can figure out what the new normal is. We know over the last decade, let's talk about what was the normal. Large cap stocks dramatically outperformed small cap stocks for a decade. The US dollar was strong for a decade. US stocks dramatically outperformed international stocks, dramatically, for a decade. Growth stocks outperform value stocks for a decade. So whether or not there's going to be a new normal is kind of what we were talking about before. There are folks who are wired to be value investors who are just drooling right now to rotate money to all those things that weren't the normal for many, many years going by. And they see great value in owning small caps, internationals. The forecast would be for the dollar to fall in value. And we certainly were toying with that forecast in 2019, where I don't know, nobody remembers this, but the trade war was the big news, okay? This unprecedented thing that had never, in my experience, the notion that we would be engaging with a trade war after my whole career seeing globalism being one of the themes, having a globally, internationally diversified portfolio construction being like a must. And so what do I think one of the casualties will be here? I think globalism is a potential casualty. I think, and as a matter of fact, I think this upcoming election, that'll be one of the issues that's on the plate. Another issue that's obviously going to be on the plate is just how Americans feel about government now. I mean, what we're seeing is a total and complete debacle in how government is handling the health part of this crisis. That's my opinion. I shouldn't say it as a fact. It's just my opinion. And that's all aspects of government. I'm not just talking about the president, but I'm talking about the CDC, the world, all the institutions, especially in the US. What a mess, I think. But the flip side of that is that the financial institutions have handled this brilliantly, as we've already talked about. So, if you...
And one of the questions that I have is, obviously, looking at, going back in time, like the government takeover of General Motors.
Right.
And so, we know that, there's certain, and we watched AIG. I mean, we watched all these types of bailouts or, where are we going with, obviously, what does it take for the government to determine who can't fail? And at what point do they jump in and sort of induce their ownership?
You can go back and read, what's his name? Is it Sorkin, who wrote Too Big to Fail? Fantastic book about the 2008, 2009, the great financial crisis. And I was in a conversation just the other day, walking somebody back to the origins of the Tea Party. and just reminding them that the Tea Party wasn't about a whole bunch of politics that we see today associated with the Tea Party. The Tea Party was a bunch of Americans who were just absolutely angry that we bailed out the banks, and that when we did bail out the banks, they used the money for bonuses and that type of thing. And it's interesting to see this time around in the fiscal stimulus package, there were some real constraints put on money that was designated for bigger businesses, where they couldn't use the money for stock buybacks. They couldn't use the money for bonuses. They couldn't use the money, which was, I think, kind of a lesson learned. How the government decides what companies are. So, for example, the airlines did well in this. Would most Americans agree that it's in the national interest to make sure we still have airlines and air travel? I guess we would. Would Americans think that we should bail out the energy industry? Goodness knows we need to put gas in the car, but these are companies that continue to produce gas, probably driving OPEC and Russia to make some of the decisions they made. Do they deserve to get bought out? Should their bonds be rescued, their junk bonds, even though they kept leveraging up and borrowing money? Well, I don't know. I don't know. I do know that those companies have not been targeted for a bailout. But I also know that President Trump and others have been jawboning that they wouldn't let that industry fail. Again, clearly it's in the national interest for us to have some level of independence from Saudi Arabia and Russia and so forth, which we're not here to talk about. So how they make that decision, I think, is entirely political. As an investor, though, which is more to the point for us, to the extent you have a strong feeling about that, again, one of the investment themes you'll find everywhere is try and find where the Fed money is going and find a way to get right in the way of that money. Probably not a bad way to protect your capital, I would think.
What happens when, kind of tell us what happens with companies that file for Chapter 11? So, you have a publicly traded company, maybe they've been struggling for a while or whatever, and, they file Chapter 11. And, I can personally, speak to this because, one of the stocks that I own has done this. And, is there any, what happens to that? From what I understand, whoever sort of bails them out, if you will, or gives them money or whatever, ends up with the stock, and that the shareholders that pre the Chapter 11 are basically wiped out. Is that what happens?
Yeah, for the most part. Unfortunately, that's the way it is. There's a hierarchy of capital that's used to finance businesses. And it kind of comes with, it's kind of fundamental to the returns that investors expect. Well, if you want to lend money to a corporation, you can, and you buy their bonds. That gives you first rights in the case of a bankruptcy. They get paid first. What they don't get in exchange for being in this preferred position is they don't get any of the earnings and profits of the business. Those are reserved for the stockholders. The stockholders have to stand behind the bondholders in this hierarchy. But in exchange for being the last ones to get paid, they do get to participate in the earnings and profits of a business. And that's kind of the way this has always worked. Bankruptcies, I was just talking to one of my analysts about this. He had researched this for one of our advisors. I think over 90% of equity shareholders get wiped out in bankruptcies. It's pretty rare for an equity owner to walk away with anything in a bankruptcy. And yes, you're right, there are firms that just specialize in restructuring, buying companies out of bankruptcy and so forth. It is a very specific, highly technical part of the business, and where I'm sure the risks and rewards are pretty obvious. High risk, high reward place to be.
So if someone, is going through that, I mean, is there a certain percent of businesses that ever come out of that that protection, that restructuring? So, let's just say for a friend, we were, speaking for a friend that they had a oil stocks in an oil company, and they're in Chapter 11. And, you look at something like that and go, okay, well, I saw yesterday where they were non-compliant with the stock exchange. They got a letter of non-compliance, and they had to put some money in there to make it to a certain amount so that they weren't taken off. And they did. But when someone's looking at that, is there ever any hope that they come out of 11 and you're fine as a stockholder?
Yeah, as I said, 90% of the time, it's not going to happen. Is there some hope? Yeah, there's some hope. As an investor, and this gets to moral hazard. It's a little bit like what we were talking about before. For many years, going all the way back to Alan Greenspan, with folks complaining, we're talking about the Tea Party, we're talking about the bailouts and the great financial crisis. You take your risks and you earn your money. To the extent that investors get a sense that they're going to get bailed out, that there is no moral hazard to corporations misbehaving for whatever way that they do. And I don't mean that by saying legally misbehaving, but if you're over leveraged, if you make bad decisions, if you do too many leases, if you're not properly reserving or hedging your oil holdings. And I'm not in the oil business, but in any business, right? To the extent that you misbehave, but there is no cost to equity investors because the government is going to backstop your business, then we get to a place that is very, very unhealthy economically. It's like a mirage where business looks good, but that's, you keep pyramiding those types of businesses. And that's where when it finally does break, it becomes a really, really bad situation. So I always, we're small business owners. So the bankruptcy is terrifying. And to the extent we know people have been through a bankruptcy, it's life-altering, life-changing. You wouldn't wish it on anyone. It's like wishing a divorce on somebody. You just don't do it. But when it comes to publicly traded businesses and this type of thing, it really is a good reminder that, hey, when people talk about diversifying a portfolio, you diversify your portfolio by the different sectors you own, by different asset classes. You diversify it, hopefully in a lot of smart ways. That's the business I'm in. Then, if you get to a place where any one business is in bankruptcy, I mean, we've been talking today about exchange-traded funds. Exchange-traded funds might have 50 to 100 publicly traded business in one of those funds. Okay, if any one of them goes bankrupt, it's news, but it isn't gonna ruin you. It's not a lifestyle changer. So just a good reflection on some of the fundamentals of good portfolio building. And while I'm on it, because I can't help myself, the other part of that is that, investors need to make sure that their portfolio policy, the amount of risk they take, makes sense relative to their financial plan, what they're trying to do. So, I make my living and I talk to people every day who their portfolio structure, they come in and it's like, well, Ken, I'm all diversified and I've got 90% in stocks and 10% in cash. And I'm good because I got this 10% in cash. And I'm kind of like, well, you have a gazillion dollars. Why the hell do you have 90% in stocks? I mean, how did you get to this decision? And did you understand the implications volatility-wise and otherwise of making a decision like this? So I always emphasize whenever I get a chance to get on this soapbox, please, folks, build your portfolio in a way that makes sense relative to what you're trying to accomplish, and only take the risks that make sense for you to take in your relative to all of that.
What percentage of an investor's portfolio do you think should be in real estate? And being REITs or direct-owned real estate, or, what do you suggest there?
Yeah, we had just, I think, touched on that a little bit earlier. When it comes to portfolio real estate, I'm somebody who's dabbled in my own, I've lost plenty of money investing in the wrong condo and made some money investing in the right condo and that type of thing. There are folks who invest in real estate for business. And so we're not talking about them and put them off the table. If we're talking about people who are going to own liquid, tradable, investable securities like an exchange-traded fund in REITs, which there are many available, then probably somewhere 3-4% of a portfolio probably makes sense. If somebody feels like they know a lot more real estate because they're in the business, half of my, no, not half, 4/5 of my clients wouldn't know what a cap rate was if they hit them in the head. Okay, I suspect that the folks you talk to know a hell of a lot more about it. So maybe for them, real estate could be a bigger proportion, knowing the risks, just knowing what the risks are of REITs, not real estate, but REITs, real estate investment trusts. And then finally, you get to what I talked about before, whether or not your personal residence should be considered part of your portfolio. If it should be, then most people have a very large exposure to real estate anyway, relative to their portfolio. I mean, if you have a couple $100,000, $100,000 of equity in your home, and you have a $500,000 portfolio between your 401k and whatever else is going on, that's a huge percentage of your portfolio. Okay, but if you don't want to count that, and a lot of people don't, then different story. Then we're back to those other percentages.
So, before we get into closing, Ken, I'm just kind of curious, interest rates. You see them staying pretty much where they are now. Do you see, there's been a lot of talk in the past 12, 18 months of negative interest rates. What's your opinion?
Well, first of all, after watching the Fed increase their balance sheets by $1 trillion a second, I don't think folks are willing to make definitive statements like we would have even 3 months ago. So would the Fed take interest rates negative? I think they would. I think the Fed has made it clear that they will do whatever they feel they have to do in order to save the economy. Those statements, by the way, are terrifying to bearish investors. So I've already admitted to being tilted that way. So there's that. But generally speaking, I think what will be in a ZIRP, you may have heard that term, zero interest rate environment for quite a while. I think interest rates are going to be very, very low. Just my opinion. I think inflation will be very, very low. If that's correct, then that gives you a hint about what leads coming out of this. You would want to stick to large cap growth. Okay, those are the types of investments that are going to lead if we do get that very low interest rate, low inflation environment. To the extent we have negative real rates, then gold is an attractive investment. We have, for us, a significant percentage of our portfolios in gold. So I think an environment like this probably lends itself to gold for some small portion of a portfolio.
Are you talking gold stocks or gold bullion?
Well, you have your choice. And again, this gets to exchange traded funds and the type of freedom and flexibility we have as investors nowadays. It's kind of a miracle. You can invest in just about anything that you might want. So there are exchange traded funds that invest in the bullion. The bullion has its own characteristics in terms of how it's going to work in your portfolio. But you could also invest in the gold miners. These are the like Newmont mining, a portfolio of companies that mine gold and are in the gold business. That ETF tends to actually be more volatile than owning the bullion. You get the leverage, if you will, of not only the bullion, but the earnings on these companies. But again, I would caution that works both ways. And at Pinnacle, we've owned both. I can tell you right now, we own the bullion. But here's the thing that I would, I guess, if we're getting towards wrapping up. Investors need to be really careful in times like this. It gets really scary. And I get phone calls from folks who just run to cash. They pulled the trigger. And while we actively manage portfolios at Pinnacle, we're not just buy it and hold it and forget it. That's why I'm capable of having this conversation. We live and breathe this stuff actually on a daily basis. Still, you need to be careful, but it's somewhere between knowing what your portfolio policy implies about volatility and making sound decisions based on the news today, and like not just ignoring the news, but somewhere between those two things is where I, like to tell people that's where your head needs to be at. If you don't want to put that time and energy into it, which most folks or many folks don't, then try and find an advisor who can help you out with it. But running to cash when cash pays nothing, it's a tough one if you have a time horizon that's 3, 4, 5 years or longer. Then just be cautious about doing something like that.
So let's talk a minute about technology.
Sure.
Because I know your industry through the years, even before the real estate industry, you have been affected in some way by the do-it-yourself platforms.
Sure.
The Ameritrade, the stock trade accounts, right? These, why do I need a financial advisor when I can manage my own money?
Right.
How do you see this current pandemic and I'm going to call it a crisis because I think it's fair enough to say that. How do you see that affecting what you do, Ken, as far as, them needing you or someone like you, that interaction, that personalization versus a couple months ago?
Yeah, I mean, if it wasn't for the fact that my business value is falling and my net worth is crumbling and my clients are upset with their life, if it wasn't for all that, I'd be skipping with joy, right? Because these are the types of environments where folks begin to rethink this proposition that they want to do it themselves. So doing it yourself through a 10-year bull market, which we experienced after the great financial crisis from 2009 all the way out through the top of 2020. I like to say there is no risk in a bull market. Every time the market makes a new high, you've invalidated any risk management that someone is doing. And I'm in the risk management business. Okay, it's only in these types of environments that people are reminded just how terrifying this is. And more importantly, recent research has shown us that people who are looking to retire, who are going to be withdrawing money from portfolios in volatile markets, have to deal with this new thing called sequence risk, which basically says even if you get high returns on your money, if the markets are volatile while you're withdrawing, then you may turn out to not do nearly as good as you might think. So we've never at Pinnacle, because we specialize in a really high-touch relationship business, and frankly, I think we self-select in terms of who comes to work with us. Someone who's inclined to do this themselves, I don't know that they're going to find anything about having great financial planners or Ken Solow and his team. And the folks that do come to work for us, for whatever reason, some of the reasons are there'll be one spouse or another who takes care of the family finances, and they're concerned what happens if they predecease the other spouse. You have folks who are just complete experts in money management who, coming into their retirement, have just decided they have better things to do with their money. We have clients who thought this was fun when their portfolio was small, and now that they have several $1 million in a portfolio, it ain't fun anymore. It's just too much responsibility, too much work. So there's a lot of reasons that people select to be what we call in the business delegators. They want to delegate this to someone else. And I don't worry too much about the industries. Look, the industries embracing technology has helped our business dramatically, starting with the types of investment securities that are around. The fact that we have technology, I can trade 1,200 individual family portfolios. So not in a mutual fund, in their accounts. My traders can push a button and not only do a trade across all those accounts, but do cross-account rebalancing, where if the average client has 6 different accounts, our software knows which accounts to buy, what securities. That is, when I came into the business, any of that is just completely unthinkable. So, yeah, what's going on at Ameritrade? By the way, those custodians, we get a nice chunk of business from referrals they give to us. This is part of their business. So, yeah, it's okay. Technology is just fine.
Yeah, well, I know in our business, certainly we kind of believe that, times like this sort of curb the technology side a little bit as far as them replacing us. So, there have been a lot of, through the years, for the last 20 years, there has been, multiple companies and platforms that have tried to replace the realtor, the real estate agent. But I really don't see, houses giving themselves self-guided tours right now. I still think they need, realtors to do that. So I think that, though they may use technology to, look online for places, I think that times like this has really helped us, and probably you as well, as you have, so well, said, how you embrace the technology, and, how people are finding you now and finding the value again. So we really appreciate your time. I mean, Ken, it's really great that you have afforded us this time and shared with everybody, your knowledge. And, how can people, what do you had said something about, you're very selective in, who, help, who you help and who your client may be. Tell us for a minute, who are you looking for?
Yeah, I mean, the way we put together kind of our unique value proposition is we said, look, in the financial planning business, it's pretty unusual, or I should say very unusual, for a firm to have invested in the money management operation that we run at Pinnacle. That's why institutional investors look to outsource that part of their business to us. For individuals, the choices are, first of all, really high quality financial planning delivered by certified financial planners who are very experienced. Pinnacle has this a great reputation, thank goodness, nationally for being the best at that part of the business. And we also do the money management, like we've been talking about, in a different way, I think, than the average financial planning company. And so what we've done is we've bundled the two, and we basically priced it so that anyone with a $500,000 portfolio, which is how we make our money, sweeping fees on assets under management. If you have a $500,000 portfolio, we bundle together the financial planning with the asset management. So our pricing is the same as any other money manager. We're actually pretty aggressively priced at higher size portfolios. But you get the financial planner, you don't pay additional fees for that. So I would say that those folks who, for the reasons I just mentioned earlier, might be looking for either a great financial plan or looking for help in money management. In our view, both of those go hand in hand, as I mentioned earlier. That one of the things that's particularly annoying to me is people who say, I don't like to take risk, and so I look at their portfolio. They made that decision, but they might need to take risks. They just haven't done the planning to find it out. So, you need to do both. We provide both. If someone is inclined because they want to delegate, they have $500,000 in liquid assets, I think that would be great. Either, by the way, that might be someone we talk about in our business. You might do the same, but we talk about money in motion. So folks who are getting ready to retire, they might have money coming out of their 401k plans. You have folks who might be getting a bequest from an estate. You have folks who might be getting a distribution from a divorce. All those are circumstances where there might be some money in motion. But mostly it's people fundamentally who get this sense that the world keeps getting to be a more and more complicated place, and they don't really feel like taking their time, energy to figure it out. It's worth it to them to bring in a partner.
Yeah.
Does that make sense?
It does. It does. So you help people not only in the U.S., you have clients that are abroad as well?
Yeah, we do. Most of them started here and moved overseas. There are some restrictions in terms of our custodians and where money can be custody, but we have an expert that works at Pinnacle in what's called cross-border financial planning. And the issues for folks who do have multiple residences, perhaps one overseas, have different citizenship and all those issues, which I can't even begin to even talk about. But this guy, he's in our Florida office. He's a nationally known expert in it. So yes, we do work for folks overseas as well.
So before we wrap up, guys, any last minute questions? Melissa, Ruth?
I have one. Yeah, Ken, just if someone's really interested in the stock market and they're very new to it and they have $5,000 to invest, what would you recommend that they do?
With $5,000 to invest, and I'm about to break my rule of giving advice without knowing anything. I mean, they have $5,000 to invest. If they've already invested $1 million and this is the next $5,000, my answer is different than if this is their first $5,000 to invest. But assuming it's their first $5,000 to invest, then again, I would just recommend that they find an index. Probably you can get a global index, the MSCI All Country World Index has every developed market in the world plus all the emerging markets in the world. If you that person wanted to just own US stocks, then they can easily, at almost zero cost, keeping in mind what's so great for investors, especially new investors, is all the custodians have cut their commissions to zero. So you can invest $5,000. It's no cost to invest it. And you could buy all 500 stocks in the S&P 500 index just by owning an exchange-traded fund or an index fund. It's unthinkable that you could do that nowadays. Vanguard started that back when I first came into business, but now with exchange-traded funds, that actually trades up and down. All 500 of those stocks are priced every second in that thing. I mean, who would have thought? So probably a great way for someone to start. And the last comment I would make about that, again, you scratch the surface, you get a financial planner, is just make sure that's not the last $5,000 you invest. Okay, so if you invest $5,000 and the market goes down by 50%, not that you shouldn't care, but you're on a very long journey. Invest your next $5,000 and the next $5,000 and the next $5,000. The most successful investors we work at Pinnacle did, and we have some accounts that are well over 10 million, 20 million. None, zero of our clients inherited their money. Okay, they all did it by building a successful business, saving, being systematic in what they do. So again, for that $5,000, find an index fund and find a way to put in your next $5,000. Okay.
Great advice. Ruth?
No, thank you very much, Ken. This is very good. Thank you.
Oh, my pleasure.
I mean, you covered so much. I mean, we could talk for days and weeks, and in fact, that would be great for me. But Ken, thank you so much. We hope everyone has gotten great information from this podcast. We are putting Ken's information in the show notes. So please feel free to reach out to him. He'd love to talk to you. His company is very well known and very well respected. So thanks for watching, and we'll talk to you soon.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.